What's up guys, I hope you are doing well and learn with us new thing by this short video. The topic of today is very interesting. Will allow you learning how investing your money in good way by minimizing the risk. So the topic of today is risk diversification in Forex. In this topic we will talk about simple definition of risk diversification, and after we will talk about using correlation to diversify the risk and intermarket correlations, and finally we will give you a strategy of correlation. Never keep all your eggs in one basket. The meaning of this famous quote is Forex traders should look to diversify their trades instead of putting all their money in one currency or pair. So diversification is a key element in managing risk in the Forex market. Definition of risk diversification. In a simple way, we can define as a process that allows traders to reduce the risk of huge losses in case that the market suddenly moves downwards by using correlation between markets or currencies. So, what is correlation and how can it measure? Correlation in general is the relation between two things in very simple way, and we can measure the correlation by using a coefficient. So we can see here that we have two types of correlation. Negative correlation. Negative correlation, for example, if we have A increase, B will be in decreasing. And positive correlation, that means, or in an example, if A in increasing, B will be also in increasing. In order to measure the strength of a positive or negative correlation, we give a number between 0 to 1 for positive correlation and 0 less than 1 for negative correlation. For example, I will explain here positive correlation, and it is the same case for negative correlation. So here we can, in general, we can say that a positive correlation is strong if this correlation is between 30% and 99%, and a weak correlation or negligible correlation or relationship is between 1% and 29%. For example, the correlation between euro-dollar and GBP/USD is 72%. That means if euro-dollar is trading up, then GBP/USD will also move in the same direction. That is an example for positive correlation. So we have here another example for negative correlation between euro-dollar and USD franc Swiss. We know that the correlation between these two pairs is less than 85%. That means they have a perfect negative correlation. So if euro-dollar moves upwards, then USD franc Swiss goes downwards. For this correlation, I will share with you. You will find all pairs and the correlation between these pairs. So let's move now to intermarket correlations. So we have correlation between pairs, and also we have correlation between pairs and commodity. The correlation between gold and Australian dollar and USD is highly correlated due to the influence of gold meaning on the GDP of Australia. Between gold and dollar is very simple. It typically have a negative correlation. And for USD/JPY and US stock market, for example S&P, they are strongly correlated. So we know what is correlation, and the type of correlation, also correlation between pairs and commodities. So what is strategy to applicate in the market? The rule number one is we should trade pairs which correlation is weak or negligible. For example, the correlation between 1 to 30%. And the rule number two is we can use this correlation to confirm your decision of buying or selling. For example, I want to take a position in euro dollar, and we know that the correlation between euro dollar and GBP/USD is very strong. So if I want to buy euro dollar, I should have a confirmation that GBP/USD also is for buying. But we have an exception. This rule doesn't work in the case of strong news, especially when it's changed its monetary policy. Thank you so much for watching this short video, and I hope that you react with this video and answer of our survey in the group of Telegram. Thank you so much again.